All right, welcome. In this video, we are going to be seeing or we are going to see how we can derive the expenditure and tax multiplier in a four-sector model, or which we say in an open economy. Okay, in an open economy. So an open economy is an economy that is exposed to the international scene. All right. So in this video, this is what we are discussing, and we have an example here. And we are working on this with the income tax. Okay, we are working on this with the income tax. In the previous video we worked on the expenditure and tax multiplier in a three-sector model with a lump sum tax. So if you have not seen that video, you can go back to that video. I'll drop a link of that video in the description. So let's move forward now. We have a question that says, given that the consumption is equal to a plus byd as equation 1, yd is equal to y minus t as equation 2, t is equal to t0 plus ty as equation 3, m is equal to m0 plus my as equation 4, and then y is equal to c plus I plus g plus x minus m as equation 5. Now the question says we should derive the expenditure and tax multiplier, and then another part of the question says what is the impact of an increase in the MPI. The MPI is the marginal propensity to import. So that said, all we can do from here is that we can come back to understanding what happens in the macroeconomic equilibrium. So with macroeconomic equilibrium, we have, as usual, aggregate expenditure or aggregate demand is equal to aggregate supply. Okay, so the aggregate demand is what we call or what we refer to as C plus I plus G plus X minus M. So the X minus M stands for the net export. Okay, so if we have to get this aggregate expenditure, aggregate demand, we have to first of all conclude the consumption function. So we have the consumption functions given to us here as a plus byd. However, we were given the function for yd. So we input yd into the consumption function. Okay, so if we input yd into the consumption function, it now becomes a plus b bracket. What is yd? This is yd here. Yd is y minus t. But it doesn't end there because we're given a function for t as well. So we replace t with the function for t, and then the consumption function now gives us a plus b bracket y minus bracket again, then t. This is t. T is t0 plus ty, okay, and then we'll close this bracket. So this is the consumption function. We can get it fully done to say c is equal to a plus b. Expand this up, we have b times this will give us by minus b times t0 will give us minus b t0, and then b times ty will give us also minus b t. Sorry, this is small t. This is small t. So just to differentiate, so minus ty. Okay, so this is what we have. This is now our new consumption function when all these other variables have been included into that particular model. So in order to move ahead, we now have our aggregate demand to be equal now as a plus by minus bt0 minus bty, now plus the investments plus the government expenditure plus the export and import. So we have plus the exports minus. Now the import, we were given also an import function. So with the import function, we have what? M to be what? M0 plus my. Okay, so if we expand this further, it gives us a plus by minus bt0 minus bty plus I plus G plus X, okay, and then minus M0 and minus My. So this is now our aggregate demand. So this aggregate demand will now be equal to the aggregate supply. But remember that the aggregate supply is also equal to Y. So we equate this to Y to get the equilibrium national income, and we have what? Y thus is equal to everything here. A plus by minus bt0 minus bty plus I plus g plus x minus m0 minus my. So we can transfer every variable that has y from the right hand side to the left hand side, or we can just general term, we can collect like terms or make y the subject formula, because we are looking for equilibrium national income. So in doing that, we now have y minus this one comes here, we have what? Minus by. Okay, that's this. Now which one has y again? Here. So we bring it here. If it comes here, it becomes what? Plus b t y, and then the one that has y again is here, and if we bring that here, we also have what? Plus m y, and this now equal to a plus b, sorry, a minus bt0 plus I plus g plus what? X minus m0. So we have gotten this now, so I'll erase from here. Okay, so I'll just bring this one back here. We have y minus by plus bty plus my is equal to a minus bt0 plus I plus g plus x minus m0. So we have this now. All we can do from here is to factorize this, all right, to bring out the y in all of this. So if we factorize, we have y coming outside, then this is 1 minus b and plus bt, okay, and then plus m. So we have this to be equal to a minus bt, sorry, you have to use the appropriate symbols or letters so you don't mix them up. So minus bt plus I plus g plus x minus m0. So we now have this, but we are looking for y. So all we can do from here is divide both sides by the coefficient of y, 1 minus b plus bt plus m. So this now gives us y standing alone because it cancels each other here. And then you have this to be equal to a minus bt plus investment plus consumption, government expenditure plus x minus m0, and divided by 1 minus b plus bt plus m. So we can simplify this further. This is the national income. We cannot get the expenditure multiplier without first of all deriving the equilibrium national income. So this is the equilibrium national income. If the question asks us to calculate equilibrium national income, this is the equilibrium national income. Or we can also simplify this further to be equal to, we just have this as 1 all over everything here, 1 minus b, okay, plus bt plus m bracket a minus bt plus investment plus government expenditure plus x minus m0. And this can also be given further, as we can still further simplify this. So this can also be given further as 1 all over 1 minus b bracket 1 minus t bracket plus m. So notice what I've done here. Everything here is the same thing as this. I only simplify this a little bit further. So if you do minus b times 1, it gives you this minus b here. Then if you do minus b times minus t, you also have minus bt. So nothing has really changed, and this also equal to, sorry, and then you multiply this by a minus bt plus I plus g plus x minus m0. So this is your equilibrium national income. Now we can use this to calculate or to estimate our expenditure and tax multiplier. But note that the multiplier or the general multiplier is already given in this formula. Okay, so this is the general multiplier, but let's see how we can derive this from here. So I will erase this again. And then we have the equilibrium to be equal to, I'll put the initial one, A minus BT, A minus BT plus investment plus government expenditure plus exports minus autonomous imports. Okay, and then we divide it by this 1 minus B. Okay, 1 minus B bracket 1 minus T. Okay, plus M. So when we have this, we can now do the same thing we did when we were looking for expenditure multiplier for the 2 or 3 sector model. So we apply that quotient rule that says U dV minus V du divided by, sorry, this is, we have V du minus U dV divided by V squared. So this is what we have there. And then we can move on to apply it here. So applying that rule, we have to differentiate, looking for the expenditure multiplier first of all. We have to differentiate the national income with respect to the expenditure component. So it can be with respect to export, respect to government expenditure, or respect to investment. So let's pick government expenditure. So if we differentiate y with respect to government expenditure, we are going to have the expenditure multiplier. All right. So kg, government expenditure multiplier. So this will now equal to, applying this principle, we now have what? We differentiate the numerator, all right, because this is our u and then this is our v. So we differentiate the numerator with respect to g as usual, and then multiply it by the denominator, and then do the same with the denominator. So we have here now, differentiate everything here with respect to g. It will take out g to stand alone, and then we have what? 1. Differentiation of g with respect to g will give us what? 1. Bracket everything here, that is the v part, we bring it down. This is the v, so we have 1 minus b bracket 1 minus t plus m. Okay, so we have this done, and then the next part will now be for us to differentiate with respect to g the denominator. So if we do that, differentiating this with, or differentiating the denominator with respect to g, there is no variable of g here, so that will give us 0, and then we have to impute everything in the u. So the u says a minus bt plus I plus g plus x minus m0. So that said, all we can do from here is to divide it by the v square. What is now the v square? 1 minus b bracket 1 minus t bracket, okay, plus m, and all will be squared. So we can see from here that this is 0 multiplying by everything here. So this clears out already. So what we are going to have here as our expenditure multiplier is going to be 1 minus b bracket 1 minus t plus m, which divided by 1 minus b bracket 1 minus t bracket 1 minus t, okay, plus m all squared. So we have two of it here and we have one here. So this can cancel out this. So we are going to have what? 1 all over 1 minus b bracket 1 minus t plus m. So this is our expenditure multiplier. Okay, so we have gotten the expenditure multiplier. The next thing now we can do is for us to derive the tax multiplier. So how can we get the tax multiplier? So we are done with this one as the expenditure multiplier. Okay, so the next thing we can do is to derive the tax multiplier. So I don't have to erase this, but I already did. So I'll just go on, and then we have written here the equilibrium national income to be equal to A minus BT plus I plus G plus X minus M0 divided by 1 minus B bracket 1 minus T, okay, plus M. So this is the equilibrium national income we did earlier. So we can also use this to derive our tax multiplier. So to get the tax multiplier, we are going to differentiate the national income Y with respect to T. Okay, differentiate the national income Y with respect to T. So all that can happen here is that the same principle applied to get the expenditure multiplier is the same principle we are going to apply here, the quotient rule. So if we do this now, we are going to differentiate the numerator with respect to T and multiply it by the denominator. Doing that, it will give us minus b. So if you differentiate with respect to t, the only place you have t here in the numerator is minus bt. So differentiate this with respect to t, you are going to have what? Minus b. So we have our minus b, we multiply it now by the denominator. 1 minus b bracket 1 minus t plus m. So we close this bracket and minus it with the same thing we have to do for the denominator here now. So we can do it. We say differentiate the denominator with respect to t. Now there is no t here. We only have small t, but we are differentiating with the big T. So that's why we need to differentiate these symbols and letters very carefully. So differentiating with t, we are going to have that there's no t here, no big T here. It becomes what? 0. Since we have 0, we multiply it by everything we have above here, which is A minus BT plus I plus G plus X minus M0. Okay, so divide everything by 1 minus B, 1 minus T plus M all squared. So ordinarily, this clear itself or they cancel out. All right, so we now have our K T, which is our tax multiplier, to be equal to B 1 minus B 1 minus T plus M divided by, this is minus B, please, divided by 1 minus B 1 minus T, okay, plus M all squared. So we have 1 here and we have 2 here, so 1 cancel 1, and then we are left with our tax multiplier to be equal to minus B bracket 1 minus b 1 minus t plus m. So this is what we call our tax multiplier in 4-sector model. Okay, so if you find this video helpful, please like and subscribe to my YouTube channel. And then in the next video, we are going to describe, or we are going to derive, or we are going to explain the balance budget, where we bring together the tax multiplier and the expenditure multiplier, and we see how the government can use that to impose an expansionary fiscal